Hi, good evening, everyone. Thank you for joining tonight's Corporate Connect. My name is Gerald, and I'm very pleased to be your host for tonight. So we have with us today Lendlease Global REIT, where we will be able to get the update from the management team on some of their key developments. We're very pleased to have with us the audience from Mumu Live with us tonight. And in case you are wondering, this webinar is organized by SIAS and supported by the SGX Group. Many of us would probably be familiar with Lendlease REIT. They own and operate properties in Singapore, such as Somerset 313 as well as GEM. So we'll be able to get an update from the management team on some of these key assets during tonight's Corporate Connect. Before we actually go into the presentation, we'll actually have an upmarket update from Emelia from SGX, where she will be able to share with us some of the recent developments in the Singapore market. Emelia is the Director of Research and FinLit at the SGX Group. And with that, I'll hand over to Emelia, who will share with us some of the recent developments in the Singapore market.
Thank you, Gerald. Okay, I've got my slides up. Today, we will talk a little bit about the S-REITs market to give everybody an update of how the sector has been performing so far. And then later on, we'll hear from both Kelvin as well as Nigel, an update over there from Lendlease. So first of all, disclaimer slide, just to sort of highlight that everything that we talk about today is meant to be educational in nature. Whatever historical numbers may not sort of predict future performance. All right, so when we talk about the S-REIT sector or REITs in general, interest rates is a key topic that has been in mind, especially since 2022, when the US has started to raise rates over the last 1.5 years. All right, and higher interest rates will continue to impact REITs, global REITs, not just S-REITs, in three ways. For example, number one, higher financing costs could be as a result of that. Number two, this could also potentially impact the distributions that REITs pay out to investors. And number three, potentially also lower property valuations and hence lower overall attractiveness to investors. From 2022, when Fed started to raise rates until end of July, we took a look at some of the numbers. The IHS REIT index, which is the benchmark for the S-REITs market, has declined about 12%. And comparatively, the FTSE EPRA REIT Developed Index, which measures some of the REITs from the developed markets, has also declined about 14%. So I'll walk you through how the interest rates will impact S-REITs, right? So if you look at the chart on the top left, right, this is the S-REIT Index total return chart that we have plotted, which is the dark blue line, against the rate cut expectations back then when we took the look at the data set for the March as well as the May FOMC meetings in dotted lines, the light blue dotted line as well as the green dotted line. So we notice, what you can see from the chart is that last quarter, when Fed started to hold rates steady, we saw REITs rally, and we're talking about global REITs, not just S-REITs. Global REITs rallied up to 15%, S-REITs rallied close to about 20%, right? And they continue to rally all the way until January, where the rate cut expectations then started to ease after that, and we saw REITs actually retrace a little bit. The index is now in the red zone, down about 7% so far in the 6-7 months of the year. The FTSE EPRA REIT Development Index is also down about the same 6-7%. And on the right-hand corner of this slide, this is the CME FedWatch tool, which is a very useful tool that investors, market can use to look at predictions or some of the expectations of where interest rates will be over the next few months, right? So you can see that initially at that time, the markets are expecting the first rate cut to come during the last quarter of this year. And we also saw the recent news from the Fed. Market is expecting the first rate cut to be in September. And in fact, close to, as of today, I had a look at this FedWatch tool, 80% of the market, 80% of expectations are expecting a rate cut of up to 50 basis points in this September meeting. Okay, this is another chart that I took from the NAREIT, which is America's REIT Association, which compares all the global REITs versus the 10-year US Treasury yield. Similarly, right? When the 10-year yields rose about 332 basis points from 2022 onwards, REITs declined about 30%. And last year, when the 10-year treasury yields declined about 100 basis points, the broader market and REITs all rebounded close to about 20%. This year, when treasury yields rose a little bit, REITs also started to decline. So you can see that obviously there is directional correlation between interest rates movements as well as the REITs' total returns. And the NAREIT CEO actually believes that the first rate cut in the US will start to see institutional funds deploy back into this REIT sector. This is another chart that I took from the NAREIT Association also. This actually talks about how they've done an analysis, right? And the analysis shows that REITs tend to outperform at the end of rate raising cycles. So NAREIT is, at that time when they released the report, which was in the middle of this year, NAREIT was they are cautiously optimistic that REITs could recover next year, and the performance of REITs that we saw in the last quarter could then signal that as monetary policy adjustments are being made later on, the end of a rate raising cycle will herald or will see periods of REIT outperformance subsequently. And the study over here from the chart shows that while during periods of Fed tightening, there's underperformance, right, for both the private, public, real estate, as well as the equities market. And after that, which is 4 quarters after Fed tightening cycles are over, there is outperformance. And in fact, public real estate from the study have outperformed equities as well as private real estate, right? And we took a look at our own S-REIT sector. Our own S-REIT sector, that sector has an average gearing of about 38 to 39%, which is still well below the regulatory limit of 50%. More than half of them are in fact below the sector's average. And close to about 3/4 of our REITs have their debt secured or hedged into fixed rates. So given strong balance sheets, fixed rates locked in, REITs should be well positioned to weather these high interest rate periods. And I think you guys might have also seen in the last 2 weeks, MAS has also a latest update for the sector. They have announced a proposal to simplify the leverage requirements for REITs. Today, there are 2 sort of requirements. One is the leverage ratio of REITs can go up to 45% if the interest coverage ratio is 2.5 times or below. And they can go further up to 50% gearing ratio if the interest coverage ratio is 2.5 times and above, right? So MAS is proposing to streamline this and to have a single gearing ratio limit of 50% and a lower interest coverage ratio of 1.5 times. This is also to provide REITs with more flexibility so that they can ensure that they can still service their debt obligations and have sufficient earnings to pay their interest rate expenses today. So last week, in our REITs column, we took a look at our S-REITs and we noted that ICR, which is the interest coverage ratio, most of the REITs report this figure today, which measures how much a REIT is able to pay off the interest on its outstanding debt. And the sector's ICR today on average is at 3.8 times. And almost all of our trusts have their ICR above the 1.5 times limit, which is what MAS is looking to propose, right? And another, aside from looking at gearing, which measures the balance sheet strengths of REITs, we also look at valuations. Now, typically REITs, for investors, right, they will value REITs in 2 ways. One is to look at the dividend yield, and the other one is to look at the price to book ratio. So when we took a look at the price to book ratio, as you can see, right, on the chart over here, typically, on average, REITs usually trade at book value. But now it is trading much lower than its average at about 0.8 to 0.9 times. This means that investors are actually valuing the REIT at a discount of up to 20% of what the property assets are actually worth, right? So value investors during this period may be looking to take opportunities. And we have seen retail investors come into this particular sector since 2022. Retail investors have net bought $3 billion worth of S-REITs in the Singapore market. This year alone, in the first 6 months, retail investors continue to net buy the sector, and they've bought close to $1 billion worth of REITs just this year in the first 6 months. And this is much higher than the numbers that we saw over the same period in 2022 and 2023, right? And on the chart on the right, we took a look at some of the top 10 largest REITs by weights. And as you can see, many of them are in fact trading at discounts against their 5-year average, ranging from a discount of about 6 to 30%. And this includes the COVID period because we're talking about the past 5 years, right? Next, this is one of the first slides of our S-REIT chart book, which is our quarterly production, where we try to put all in one chart book relating to the sector, where we have different stats that investors can refer to when they look at the sector. So over here, you can see that S-REITs continue to be a very important part of our market. They make up about 12% of our total market cap. But in terms of the Singapore market, it trades at about 1/4 of the daily turnover. The average distribution yield of the sector is close to about 7-8%, and the sector is very well diversified in terms of property type as well as markets. And this is very important because diversification allows you to diversify risks the same way REIT managers also diversify into different asset types to diversify across industries, customers, and also the different currencies. So this is our quarterly chart book. We don't just have some of these numbers. We also have, you're able to also look at things like the distribution yield across different sectors. You can also see over here what we've done is we've plotted the S-REITs distribution yield against the volatility rate. And you can see for our S-REITs generally, one of the higher distribution yielding markets and a lower volatility. Last slide. Last chart that I also took from the NAREIT Association. This shows the 2023 real estate allocations by institutional investors. So you can see that retail investors, they're not the only ones that buy REITs. In fact, it forms a key part of Insti investors' own portfolio too. And here are some reasons why Instis will consider REITs, right? Because of the allocation needs, liquidity objectives. And the last one I feel is also relatively important because it allows you to invest and get exposure into certain sectors that otherwise an investor it would be hard to sort of directly purchase a physical property. So with that, thank you for staying with us. I hope you look forward to the session later with Lendlease. I myself also keen to hear a little bit more from them and hear from the latest updates so far. So thank you, and I'll pass the time back to Gerald.
Thanks, Emelia, for the market update. We are very pleased to have with us representatives from Lendlease REIT management team, as well as investor relations team. So tonight we have with us Mr. Kelvin Chow, who is the CEO of Lendlease REIT. We have with us Bilin and Nigel from the investor relations team. So with that, I'll hand over to Nigel, who will give us an update on the company. Nigel, over to you.
Thank you, Gerald. Good evening, everyone. So today I will be presenting REIT's second half and full year financial results. So let me share my screen. Okay. Gerald, are you able to see my screen?
Yes, I can.
Yeah, okay. So yeah, without further ado, I will proceed to the key highlight page of our second half financial year FY 2024. So for the financial performance for REIT, we actually registered a gross revenue increase 7.8% year on year to 220.9 million for the full year. So this is because of two main reasons. So one reason is because of the healthy operational performance from our Singapore assets. And the second one is because we include the recognitions of the supplementary rent from the lease restructuring with Sky Complex. So just a quick recap for everybody. So REIT actually have the lease restructuring with Sky Complex back in the first half FY 2024 in December last year. So during the lease restructuring, we actually received the supplementary rent equivalent to about approximately 2 years from Sky Complex for the lease restructuring. So with that, the net property income also increased in tandem to 7.4% year on year to 165.3 million. So distributable income for the full year was 91.4 million, which translates to the distributions per unit at 3.87 cents. So the lower distributions is due to the higher borrowing costs as compared to last year. So as you can see under the capital management sections, the weighted average cost of debt for the financial year ended 30th June was 3.58% per annum, as compared to 2.69% for the same period last year. So REIT's gearing ratio stood at 40.9% as at 30th June, with interest coverage ratio of 3.2 times, and also our fixed rate hedging was 61%. Moving over to portfolio metrics, REIT portfolio committed occupancy improved to 89.1% from last quarter of 88.8%. So for the individual portfolio, our retail portfolio actually achieved 100% of full occupancy, while our office portfolio was 80.9%. Our retail portfolio tenant sales registered an increase 0.2% year-on-year with retail rental reversions of 14%. REIT continue to maintain well-balanced weighted average lease expiry of 7.5 years by NLA and also have a healthy tenant retention rate of 84.9% by NLA. Effective from April 2024, we also obtained the office rental uplift for our Building 1 and Building 2 of Sky Complex, while the Building 3 is still undergoing repositioning for multi-tenancy to secure the market rents. So moving over to financial performance. So these slides may have a bit of information here, but actually some of them are covered in the key highlight slides. So if I can bring your attention to the table below. So as I mentioned previously, so gross revenue and net property income actually registered the growth of 7.8% and 7.4% respectively. Even though if we exclude the supplementary rent that we recognize in advance, gross revenue will still increase by 3.2% year-on-year, while the net property income will increase by 1.3% higher year-on-year. Likewise, for the second half for the FY 2024, if we were to include the support from the supplementary rent, actually the gross revenue will increase 1.4% year-on-year instead, while the NPI will also register a lower decline of 2.6% year-on-year. Moving to our balance sheets. So as at 30th June 2024, REIT maintained the total assets at approximately 3.8 billion, with total liabilities at approximately 1.6 billion. This results the net assets to 2.212 billion, and the units in issued as at the period ends was 2.376 billion and translate to a NAV per unit of 76 cents. This slide shows the debt facilities and our maturity profile. So as at 30th June 2024, REIT has 168.6 million of undrawn debt facilities for the working capitals. And for the chart below, you may notice that for the next financial year, FY 2025, there is a 360 million loan that is due for renewal. And the management team is already in discussions with the banks for the refinancing. Moving on to capital management, some of the key highlights here, some of the key points here have already been covered in the key highlight pages. So just to bring up the 2 points in this slide is that post the financial year ending 30th June 2024, we actually increased our interest hedging up to approximately 70% from 61% to better manage our borrowing costs. REIT sustainability-linked financing actually accounted for approximately 85% of the total debt, and we have achieved interest savings from it since the establishment of the green finance in FY 2022. This slide shows the distribution schedule, and our unit holders, you can actually expect to receive your distributions payment date on 26th of September. And one more thing to highlight here is that for this half year, we will also launch the DRP. And for unit holders, you can subscribe to our DRP before 10 September 2024. Moving on to portfolio performance. As I mentioned earlier, REIT continued to maintain a well-balanced, well-spread lease expiry profile with a WALE of 7.5 years by NLA and 4.7 years by GRI. In terms of lease expiry in FY 2025, we have de-risked the lease expiry to 8.9% by NLA and 16.8% by GRI. So overall, REIT portfolio office tenants continue to account for approximately 21% of portfolio GRI. And our office long WALE will continue to ensure stable cash flow for REIT unit holders. Just to bring some highlights on our diversified tenant base, the top 3 tenants is the category will be the food and beverage, 28.4%, followed by the fashion and accessories, 12.2%, and the government of 11.2%. Going into retail portfolio. So on the left side of the chart, you may notice GEM actually achieved full occupancy as at 30th June 2024. And the 313 at Somerset also improved its occupancy from last quarter from 98.7% to this quarter 99.9%. So if we were to combine them all and round up, so it will give us a full 100% of retail occupancy. On the right side of the chart, there's the tenant sales and the visitations. So overall, for the full year, tenant sales and visitations are increased 0.2% year-on-year and 3% year-on-year respectively. So as you may notice, the last quarter, April, May, and June, we actually registered a bit of muted numbers. One of the reasons is because of the strong Singapore dollars, which encourage the Singaporeans for outbound travels, and also have a bit of restrictions of inbound travel due to the strong Singapore currencies. Going into office portfolio, Singapore office portfolio, which is the GEM office, continued to be fully leased to M&D until 2044. So one of the things to highlight here is that for the rental review for GEM office, it will be happen later this year in December, and we are looking forward to have good numbers of rental uplift for our unit holders. So over in Milan office assets, the Sky Complex, the occupancy stood at 73.9% as at 30th June. And we continue to see positive leasing interest for the space at Building 3. And we are in discussion with a few prospects right now, and we look forward to provide more updates to the unit holders as we progress further. This slide is showing the portfolio valuations. So for the financial year end, we also done the valuations for our portfolio. So looking into GEM and 313 at Somerset, GEM registered a 3% increase in terms of valuations, while 313 at Somerset registered a 1.3% increase in valuations. So the cap rates for the Singapore assets actually remain quite stable without any change. On the other hand, for Sky Complex in Milan, registered a decline in valuations from last year 290.5 million euro to this year 263.1 million euro. So this can be accounted for two main reasons. One reason is because of the higher cap rates that increased 25 bips to 6% this year. Another reason will be the valuers actually take into considerations the lower occupancy at Building 3. Moving on, these slides is just to show some of the new F&B and retail tenants that we welcome on board into REIT's retail portfolio assets. Moving on to sustainability, we have one slide for this one. So for sustainability, it continues to form the integral part of REIT's business operations. Just a quick recap for our GRESB results last year in 2023, we continue to hold the global and regional sector leader in the retail category with 5-star ratings. And we also continue to score A in GRESB public disclosure. In order to further enhance our sustainability journey, we are partnering with ESCO consultant to look at reducing our energy consumptions at REIT Singapore assets. Also not to mention here is that REIT's 100% portfolio actually is green building certified. Looking ahead, our key focus in the near term will be still covering these few areas. One of it will be the proactive asset management to drive operational performance. More particularly is the looking forward to the lease rental review with GEM office coming up next later part of this year, and then also including the prudent capital management to manage our costs and gearings. Specifically will be the upcoming 360 million loans that we will be coming to refinance. So I've ended my presentations and I will hand back to Gerald. Thank you.
Thanks so much, Nigel, for the update. With that, we'll go to the Q&A session for today. So for audience who are keen to ask your questions, you can put it into the Q&A box in Zoom. For the audience from Mumu, do click on the link to join us in Zoom to be able to pose your questions. We'll aim to be able to take as many of your questions as possible. Okay, there are actually some pre-submitted questions that I will go through first. I think earlier Nigel gave an update on capital management balance sheet, but there are probably some questions that I do see being asked quite often. The first is really regarding the interest coverage ratio. Given the high interest rate at this point in time, as well as the need to maintain a certain interest coverage ratio, how do you intend to go about doing it?
Right. And first of all, good evening to everyone, and thanks for participating in this event. And very nice to actually touch base with a lot of retail investors, which that is the part that we sort of miss, and we want to actually sort of continue to grow our presence with the retail investors. Okay, back to the questions. I think it's very interesting that you have mentioned that of the high interest rate environment and also the coverage ratio, but also I think the investors might actually, sort of notice some market phenomena that is very clear. I think two of it is very obvious. First of all is that I think we are probably close to the peak of the interest rate cycle. Which now people are looking at how the interest rate will be cut and how much is cut and all those things. So obviously people already know or feel that that is the peak. I think that's one of the phenomenon that we have seen. I think the other interesting phenomenon is that now we are actually at an inverted interest rate curve. I mean, it still continue to be as an inverted curve. So what it means is that the shorter end, which is a spot rate, is actually higher than a 5-year rate. So I mean, the most important is that how you actually make or take advantage of this situation or this phenomenon to actually improve your current situation. So for those that are actually following us, you will know that our interest rate hedge ratio has been relatively low. I mean, as at end of June, which is our financial year, it's only 61%. I think that actually gives us a lot of benefit to sort of capitalize the falling interest. I mean, as I said, the first phenomenon, and also it gives us a lot of opportunity to hedge our positions to take advantage of a lower interest rate on a longer term basis. So that's why when Nigel made his presentations, we already technically hedged another 9% of our positions to increase from our hedge position from 61 to 70%. I think these are things that we sort of need to capitalize. Of course, nevertheless, when the banks look at how and why they should refinance you, I think the most important thing is that your portfolio has to be able to perform. I think if you look at all our portfolio metrics, I mean, we have high interest rate rent reversions. We have high rent reversion percentage of 14%. I think that is remarkable. We have a strong retention. That means the tenant never want to leave us. And also our occupancy rate is high. Of course, we didn't actually obviously mention is that the ops cost for the mall is actually lower. So what is ops cost? Basically, ops cost is to the tenant is the rental that they pay over their total sales. So if the ops cost is relatively low, that means their rental actually is actually lower than what they pay compared to the market to the sales that they have grown. So if their sales grow, that means that percentage will continue to fall. And so far, I think this is the case, and this proves that our mall actually have been running quite well. So in that case, it helps the tenants to grow. Of course, at the same time, it helps us to also grow our rental revenues through the reversions. That's why we achieved the 14% reversion. So very importantly, strong portfolios performance is important. Continue to strengthen that. I think that will help us in negotiating with a good rate with the bankers, and then that will help us to sort of maintain a lower interest rate margin. And secondly, with the low hedge profile, that will help us to sort of manage a future interest rate growth, leveraging on the two phenomena that I have mentioned.
Okay, a related question to that. So one of the points you mentioned was that there's a likelihood that interest rates will start to come down from here. There's a question from an investor. what happens if the Fed's anticipated rate cuts do not come through? In this kind of scenario, how is Lendlease REIT going to be able to cope with the elevated interest rates?
Well, I think it's a very interesting question, but I just want to emphasize what will destroy a REIT was certainly, based on my observations, is either mismanagement of the REIT or they have focused in the wrong sector or wrong market. But it never, because of the macro environment that actually caused the REIT to to destroy or damage and also in a bad state and kind of things. So as long as you focus very well on what you should actually emphasize on, for us, I think we emphasize very much on the growth of the portfolios. That's why you can see that, we continue to report a lot of positive, I think, operation metrics and all those things. That is to sort of emphasize to the investors that we are continue growing while the macro environments continue to be challenging to all the REIT across the industry that impact all the REITs. So if let's say things that can impact everyone, so that is something that you just need to hunger down and focus on how you can actually defend yourself, because at the end of the day, everyone will suffer, and you just need to be sure that you will be last man standing. I think that is what we should actually focus on. So macro environment will never be you never kill you if, let's say, you can manage your asset well and know how to position your asset and focus on the right market that you are talking about. So your actions, the management actions, means a lot to this type of uncertainty in the markets.
Okay, related to that, I think we'll just take all the questions relating to your balance sheet first. Is on perpetual debt. How do you plan to manage the cost of debt, especially your perpetual debt? There are potentially cheaper funding sources that are available. Would this be something that you continue to consider, or whether there are other options that can potentially come in?
Okay, I think for perpetual debt, of course, is one of the instrument that we use when we do acquisitions of GEM, but it never means that it cannot be replaced and all those things. And of course, there are several ways to manage it. First of all, for those that follow us, they know that our first perpetual, we're going to fall due next year around April. So I am actually sharing with some of these investors is that it depends on how you expect or what is your trajectory of the interest rate dropping. If you feel that the interest rate will drop very drastically, so in that case, you probably no need to do anything now, but roll over the existing perps. So as you roll over, it doesn't mean that you roll over for another 4 years or 5 years. You just roll over for another half a year. So that will continue to provide you the benefit of probably catching a lower interest rate since it's fallen so drastically. So, but if let's say the interest rate are falling off and pause and fall and pause again, that means it take a long while for it to actually reach optimal rate that you are actually target on. Then in that case, probably you should actually repay your existing one and roll over to the other one. That's why I say it actually depends on how interest rate will unfold themselves and then how you can manage it. Of course, the other things that I think we have also mentioned earlier on the presentations that basically the MES is actually changing the way they sort of monitor the gearing of the REIT by increasing to 50% as long as your interest coverage ratio maintain at 1.5 times. I think we do an analysis. If let's say we were to convert our perps that is fall due on April next year to a debt, our gearing will certainly increase, but it's still within the MAS threshold, and that will probably help us to position ourselves on a cheaper funding cost to instead of a perp. So that is something that we can also work on, but it doesn't mean that we will work on that solution. But I think that is something that actually will also have a positive outcome to manage the cost if let's say you want to embark on that. But it's just a solution. There are a few ways to skin the cat, but I think we just just suggest some of this.
Okay, still on the cost of capital, but moving a bit also into growth strategies. So given the elevated interest rates, how do you think about acquisitions in today's environment?
I think the acquisition is continue to a it still will be meaningful, but I think most importantly has to leverage on I think the strength of your sponsor or what you actually have in different of the others. I think what happens to Lendlease REIT is that we do actually have a uh, very strong sponsor that has a lot of asset in Singapore. So what it means by a lot is actually we are saying that it could be close to around 10 billion of asset has yet to be injected to the REIT. So I think that gives us a very strong position to continue to be identified as a Singapore asset REIT, because I think we want to gravitate ourselves to our portfolio more in Singapore assets. So that helped us to grow our Singapore presence. I think that is something that we can actually sort of give the unit holder more confidence, because most of our unit holders are in Singapore. They want to see how the performance of the asset going to be and all those things. Given that we have that kind of portfolio, which I think you probably can't find in other sponsor, that actually will be very helpful for us to continue to be able to provide the presence, and also have some kind of confidence from the unit holders as they invest in us, because they do able to look and feel and also be able to somehow even participate. For example, if it's the mall that we acquire, they can even go to the mall and understand more about the mall. I think that's the beauty of it. So I think we believe growth is necessary, but growth in the right way, growth in a way that the unit holders actually prefer. I think that is more important. And given that we have a very strong Singapore asset base from the sponsor, I think that will help us to continue to add confidence to the unit holder as we grow. So we will gravitate to to grow our asset in Singapore to get that confidence from the unit holders.
So we'll go asset by asset in terms of potential acquisitions. There's a question around Paya Lebar Quarter. This investor has the perception that it's a good performing asset. Any plans in terms of acquisition of Paya Lebar Quarter?
I think it's very interesting. We do actually have a few assets on the plate, and Paya Lebar Quarter, of course, is one of the few assets that I mentioned within the 10 billion asset base that we have from a sponsor. But we need to sort of approach it, I think, in the best way that we feel that it will generate values for the unit holders. So at this moment, we look at that, and also compared to our trading price, it might not actually be a accretive acquisitions for our unit holders. That's why we sort of put it on hold. I think the good thing is that while we put it on hold, I think our sponsor continue to manage the asset. We continue to have the visibility of how the asset operate. I think that help us to sort of like find the most suitable time for us to acquire. But at this moment, I think based on some kind of criteria that we have, I think which this criteria we have mentioned in our IPO prospectus, that I think it hasn't sort of met that kind of criteria, so we didn't actually acquire. So we pretty much strictly follow the books of what we are doing. At the same time, we are very close to the sponsor. We know the performance of the asset, and that help us to time our acquisition more appropriately when the times and opportunity comes by.
Okay, I'll jump to some of the live questions. There's a related question on acquisitions.
Yes.
This one is relating to Parkway Parade.
Yep.
Any chance or opportunity to increase your stake in the asset?
I think they always chance the opportunity for us to increase the asset, but at this moment, it might not be a priority. And for those that actually sort of, follow us, they would know that when we acquire this small stake in the Parkway, it's mainly to sort of leverage on the growth of Parkway through the completion of the development of the MRT, and also some of the refurbishments of the surrounding facades that actually enhance their performance and all those things. So this part of it, we are observing and see how much that we can sort of capitalize on that and how that will means it translate to the value of in terms of distribution, also translate the value in terms of the asset itself. So that part of it, we are observing it. It doesn't mean that we will not grow or continue to buy more as we more stake, rather increase our stake in that asset. But we have to be very careful to make sure that everything that we do, every asset that we invest, it do actually have a very positive value creations to the investors. I think allow me to actually point you back to our acquisition of GEM. I think for those that know how much we have acquired for GEM, I think you should know that the value of the GEM has increased by around 8.4%. And that is barely 2 years. And if let's say we were to acquire something, we want to have that kind of good growth trajectories and continue to generate very good cash flow, stabilities, and future proving. And GEM actually is one of the few assets, or rather, our whole portfolio is actually green certified, and GEM is one of the platinum certifications asset that we hold on the portfolio. So these are things that we always looking for, not only for the current situations that we see good values generate from the asset, but also future proving ourselves. I think that is what we are looking at. So in short, I mean, we are not, we never say no on acquiring more of Parkway, but we need to understand whether the values that it create really make our investors appreciate that the asset acquisitions that we're looking for. So we have to time it right also again.
A related question on Parkway Parade. How has the sales actually progressed since the opening of the Thomson East Coast Line?
Actually, I mean, there are sensitivities on us disclosing some of these metrics, but based on my observation, it's just my observation, I think the traffic has been improving. I did went down for a few rounds. I feel that there are more food at higher footfall. I think also based on what I have observed, I think the offering, the tenant mix actually has been sort of transformed and changed. I think that helps the mall to perform better. I think it's a very interesting outcome based on my observation. But of course, given that we are just a small little investors in the whole fund of Parkway, I cannot disclose too much. But based on my observation, I think the metric has improved.
Okay, now we'll move on to some of your existing assets. Quite a number of questions on Milan, starting with this question from King Ling, who posed this live question that the supplement rent for Building 3 in Milan is front-loaded in this house revenue. The subsequent house may not have such a supplement. So what is the likely impact to the DPU?
Yeah, I think for those that understand how this supplementary rent has been is working, is that basically it's just subsidize the the short of the cash flow for the next 2 years. So what happened is that while we do actually have front loading of this 10 over billion that is for this supplementary rent in the P&L. But when it comes to distribution, we actually sort of spread it across the 2 years. So, unavoidably, that is how the accounting need to recognize the revenue once we receive it. So once we receive it, we put it into the gross revenue, and then it seems that the gross revenue has grown, but it managed to spread across 2 years. So that's why when it comes to the distribution, that's mean on the DPU line or the distributable income line, we apportion it so that in the case only the right number of months and the revenues that to be recognized within that months has recognized for the distribution. So in that case, there would not be a shortfall of revenue for at least for the next 1.5 year, given that we only recognize probably around half a year kind of revenue for this distribution.
Okay, and in terms of the operational aspects, any expectations on when the Building 3 is expected to be completed, contributing to your DPU, and how is the current leasing situation like?
Yeah, I think as we spoke, I think we already continue to lease out our space. I think to your understanding is that we already have some occupancy of the space, and we are moving towards another few more closing to conclude some of the leasing activities, and that probably will move us to around close to 20% of the lease activities as at now. And of course, we continue to see very positive kind of renters, tenants, prospect, and all those things that are coming to us. And we look at the prospect and the requirement of the space they are talking about. If all the prospect become materialized, I think that will technically fill up the whole building. So the prospect actually is not small names. Some are big operators in the industry, like from the steel industry, from the academy industry. I think from the fashions industry. I mean, if I name it, you will know who are they. So these are big names that actually looking for office space that actually relevant for them. So more important is how we make our office relevant for them. I think it's the connectivities of the office location that we have. I think it's very hard to find that kind of location with well connected with train, metro station, and all those things. And also we are just probably 10 over minutes to the Linate Airport, which connect throughout the whole Europe and all those things. So this make us appeal. Of course, the other thing is that the green certification of the buildings is one of the other plus point. And also we are not only the building that is green certified, but we also have the district that is green certified. That actually is one of probably the only one so far in the whole of Italy that has that kind of green certified district kind of certifications. So that actually sort of give us one level up in terms of improving our leasing activities and all those things. I think last but not least, of course, I want to mention that our floor plate is pretty much very efficient. I think very much columnars and all those things. Again, these are buildings that you hardly are very difficult to find in CBD area, which I think ours is probably the second options besides CBDs with that kind of efficient kind of layout. I think more importantly that I think investor might want to actually know is that we technically are trying to improve our renters from the building that we try to generate by probably 50% or more. So for example, if I were to lease based on the previous lease arrangement that I have, that means my building fully leased to Sky Italia, I might collect $100. Now I am able to collect $150 for the building 3, and somehow it's even more. So what it means is that even if I would not be fully leased out the whole space, my break-even point could be only 70%. So if I were to lease out 70% of the space, I'm all good as neutral. But if I lease out more, that means it will be more to distribute to the unit holders. That is why, and that is the motivation why we actually sort of want to convert this building itself to a multi-tenanted buildings. Hopefully, investor sort of understand the whole logic of why we are doing that. We are trying to enhance values for the unit holders by doing that. And so far, I think the strategy seems to be still in the positive way, and we continue to see it on that kind of directions. Yeah, that's hopefully I think enough of sharing to the unit holders.
A related question from Mui Kwang, also relating to Sky Building 3. When is the building expected to stabilize in terms of occupancy?
Building 3, basically, I think, as I mentioned, if let's say you're stabilized, mean that when do we roughly achieve what we can achieve previously? I think, as I said, it's the 70% mark that we're talking about. So if we were to be able to fill up the 70%, I think to 70%, I think within the 2 years time, I think we are good enough. But of course, filling up more, I think you will probably be able to sort of provide more income to the unit holders. So of course, we want to do that. So while we are actually trying to sort of continue our leasing activities, which I think is going on quite healthily given our very unique and very good locations. And also, if someone were to know someone, if you were to know that, I mean, the location of the building actually is very close to the Winter Olympic in 2026, you will also know that there are also prospects that actually going to sort of like continue to work on this arena that actually meant for the Winter Olympic pre and after the events will also be located at the areas. And our building is probably the only few buildings that around the areas that is available for them to lease. And the arena that they built will not be tear down after the Winter Olympics. So there are activities going on. So it make our buildings very relevant. So I think technically, I think the leasing activities will continue to be healthy and doing well. It's just a matter of how we want to sort of quickly lock in some of these prospects, because we want to actually have a strong prospects that actually continue to provide us a very strong cash flow. So we want to fill it up with good names and good tenants. So that's the reason why we could be quite selective. At the same time, I think the leasing activities is also a little bit slower compared to Asia. That's how it works so far in Europe. And also not to mention is that now is the summer holiday for Europe. Literally for the whole August, they are probably having a break. So again, that will slow down some of the process.
Everyone is probably watching the Olympics.
Yeah, exactly. That's
Okay,
true.
now we'll move back closer to Singapore. Quite a number of questions relating to the Grange Road car park. Can you able provide an update in terms of what is holding back the project? When can we actually expect construction to begin?
Okay, I think the Green Shoot car park is started off with a very simple uh, uh, kind of structure, and now because of the ambitions of the STB and SLA, I think it become a more elaborate kind of structures that we will probably technically be able to house from a very small concert to different kind of events that is happening, and we envisage. But of course, the whole intention is to grow the local talents, at the same time see how we can sort of marriage the Western and the local uh, knowledge together as we grow this industry. So it's a very complicated, but it's a very strong propositions for us to sort of make these venues work. So because of the more elaborate kind of structure that we are looking at, and the more deeper way to sort of unfold some of the activities we are talking about, that take a longer time. But I think we are there. I think we managed to sort of clear some of the most of the authorities' requirement, because if it more elaborate, that means you're looking at a more solid structure. A more solid structure has to be able to, I think, soundproof, be able to make sure that the evacuation is clean and easy when it comes to any kind of emergency and all those things. These are things that the structure has to address, which is very different from a typical kind of stadium kind of structure. So hopefully I give you enough of complexities to talk about the structure. So that itself takes some time, but I think we are close close to getting it across the line. So once it cross the line, I think it should take around 12 to 18 months for us to sort of construct the asset. And then once it's done, the asset probably will be there for the longest time, because it's a very solid asset. It could probably stand tall for another 30, 40 years. It's a very solid asset that we're talking about, and it will certainly change the face and look and feel, and attracts a lot of different people that come to the venue itself, which is very much aligned to the whole visions of 313. That's why we sort of support the project to sort of go on.
Okay, moving next door, any plans to capitalize on the extra NLA for 313?
Yes, I mean they always be, but the plan has to gradually deploy instead of a one-shot deployment. While we see, I think the sales and footfall has been improving and all those things, but any kind of major change or major construct of the buildings means that you will have to first of all halt the place. Secondly, you might uh, affect some of the operation from the tenant that you need to sort of stop the operation and all those things. This uh, this will be a moment that you will actually have to stop the cash flow for the time being, because certain kind of level of the tenant, you might he might even need to compensate them for doing the sort of major work and all those things. So these are things that we do not want it to happen now, given that the interest is still at the high side, which I think that will compromise on our distribution if, let's say, we do that and affect the distribution. But it doesn't mean that we stop there. I think progressively, when we see a tenant moving out and the next tenant come in, and we feel that opportunity for us to deploy more space on that floor itself, I think we will do that. So we slowly move, dish out this additional space to some of these other tenants that which their surrounding space can sort of like fulfill and add up some of the space. But we cannot do in a very major very big project, so that in that case we do want to affect our current cash flow, because I think we still not at that moment have a luxury to sort of have some cash flow disruption yet. I think that's something that we are conscious about.
Okay, do you see the muted growth of tourist arrivals impacting Lendlease REIT?
I think if let's say we are talking about only a mall in the downtown, it could somehow be impacted. But I think, again, very fortunately, we have GEM in the portfolios, which I think suburban mall is never been supported by tourists, but always been the surrounding catchment and all those things. So that is a plus point that we sort of have and discover. That's why we during our acquisition of GEM, we strongly encourage the unitholder support. And thanks for the unitholder support, we acquired GEM, and it proven to be right. As to 313, I think it also slowly convert it to we sort of change its identities so that it actually attract the young professionals to come to the mall. So we are not so dependent on the tourists anymore. But of course, tourists that come to Singapore will tend to go to Orchard Road, and we will hopefully be one of the mall that were able to attract them to spend on the money. I mean, that is very, very important. But nevertheless, we're trying to sort of like feed our tenant mix to actually be able to attract the young professionals to continue to spend the money over at our place. So that, I think, strategy proven to be strong. So in that case, we continue to see very strong growth on the sales numbers. While the footfall might compromise, we end up get back to what we are, because tourists do actually feel some of the food still be some part of the footfall that we are talking about, but it doesn't compromise on the sales number. So I think that's something that we're trying to sort of transform ourselves. So I would say that the tourist still relevant, but it not technically jeopardize or cause any big issues to our tenants' operations. Likewise, it will not likely affect our rental collections.
Okay, and just a question on cost. The utilities cost actually increased quite substantially in your most recent half. Is this expected to come down from current levels?
Yeah, and thanks for the question. And if you refer to one on our third quarter announcement, which is somewhere in April, I think you will notice that we managed to lock in the utility cost at a 30% discount. And assuming, or rather you look at it, our utility cost, if it's around 15% of our whole operating cost, I think 30% cut will be, it's a very significant numbers. So we managed to lock it in, and perhaps it's one of the lowest kind of utility rate that is available, we have locked in, throughout the whole REIT market, and we are very pleased that we have to make this action. And in fact, some of these other REIT was also trying to check with us, is it, how do you actually manage to get that kind of rate and all those things? So we share with them. We're happy to sort of give them that kind of understanding how we sort of monitor the market to capture this rate. But that certainly will be a saving, I think, starting from the new financial year, which is 1st July onward for the next 2 years. I think this saving itself, if it translate to DPU distribution, again, it will increase by another 0.2 or 0.3 cents. I mean, that's how we look at it. Yeah, if let's say we convert it to a distribution.
Okay, maybe just one final question. This will also help to round up today's session. This investor has been holding on to your shares since IPO, and he would just like you to analyze why some investors do not seem to be interested in investing in Lendlease REIT.
I think it's a very interesting question, and also I like to say that I'm also the unit holders. So in that case, I have the same sentiments and also have the same urge to sort of improve the performance of the REIT. And of course, if you invest in the REIT and invest in the REIT with a very specific sectors, I think you will have to expect some of the up and downs due to the natural asset cycle that you're talking about, the investment cycle. And you also face a lot of different macro changes and all those things. These are trends that I think you have to face it. But I mean, as long as you have a strong confidence of the portfolios, I think more importantly, whether the portfolio impress you is very important, because portfolios that we are talking about will have to able to generate regular returns and stable returns to you, and also in terms of valuation, able to generate a very strong valuations that will actually represent on the trading price. I think that is very important. I think a lot of things, I mean, these are the first point. The second point is a lot of times the investors sort of miss a very important key point, is that whether this as the portfolio itself is green certified, or whether it actually has a very green potential. Because this, we are not holding assets just for the current moment, we are holding asset for the future distribution. Is a long-term distribution. I think this portfolio that we have is, I mean, all the asset is green certified, which will able for us to actually future proof ourselves. People are looking for how asset can be future proofing. I think some of the asset in some of the REIT is not able to convert into green. I think that investor has to be very cautious, so that in the case when they invest, they know that they are not buying a asset with a very future looking things, but it's more of the near term return. So that is something that we are looking at. So what actually stopped investor from investing in us, I think probably is due to the interest concern. But again, I have addressed on the first question, is that as long as you see how the two phenomenon, I think the peak of the interest rate and you see the inverted interest curve that is actually happening, and we can sort of capitalize on that and actually reduce our interest costs. I think that is something that eventually will able to attract investors. So our REIT is very much linked to the movement of the interest rate, and probably our correlation should be even stronger than the others, because we have a lower hedges compared to others. So what it means is that if you are lower hedges, the interest rate or the move down, you will benefit more than the others compared to those that actually hedge higher, because they cannot actually sort of take that kind of improvement of the interest rate environment to the P&L, because they have already hedged their position. So for us, watch out for the interest rate movement. We will certainly be able to benefit from that. I think if let's say it happens.
Okay, thank you so much, Kelvin, for your sharing tonight and for taking all the questions by the participants during today's session. With that, we'll end today's Corporate Connect. For the audience who have joined us today, we hope you found the Corporate Connect session informative. And if you've got any further questions, please feel free to contact the company. In case you missed any part of today's session, you can rewatch the webinar on SIAS Facebook or YouTube channel. For those who are new to Corporate Connect, it is a monthly webinar. You can visit the SIAS website to get updates on some of the ongoing investor education programs as well as initiatives. The next Corporate Connect webinar will be with Cromwell European REIT on the 20th of August 2024. If there are other companies that you would like us to also feature, you can share with us in the chat box as well. So thank you so much for joining us this evening. Thank you, Kelvin, Nigel, and Bilin for joining us tonight. We hope that you have a very good evening, and do join us for the next Corporate Connect webinar. Thank you.